In Chapter 2, The Education of Warren Buffett, very few people can come close to Warren Buffett's investment record, and no one can top it. Through 4 decades of market ups and downs, he has continued on a steady course with unmatched success. What he does is not flashy, even at times very much out of favor, and yet over and over, he has prevailed over others whose exploits gave them temporary, flash-in-the-pan stardom. He watches, smiles, and continues on his way. How did Buffett come to his investment philosophy? Who influenced his thinking, and how has he integrated their teachings into action? To put the question another way, how is it that this particular genius turned out so differently? Warren Buffett's approach to investing is uniquely his own, yet it rests on the bedrock of philosophies absorbed from 4 powerful figures: Benjamin Graham, Philip Fisher, John Bohr Williams, and Charles Munger. Together, they are responsible for Buffett's financial education, both formal and informal. The first 3 are educators in the classic sense, and the last is Buffett's partner, alter ego, and pal. All have had a major influence on Buffett's thinking. They have much to offer modern day investors as well. The Warren Buffett way. Benjamin Graham. Graham is considered the dean of financial analysis. He was awarded that distinction because, before him there was no financial analysis profession, and after him they began to call it that. One Graham's 2 most celebrated works are Security Analysis, co-authored with David Dodd, and originally published in 1934, and The Intelligent Investor, originally published in 1949. Security Analysis appeared just a few years after the 1929 stock market crash and in the depths of the nation's worst depression. While other academicians sought to explain this economic phenomenon, Graham helped people regain their financial footing and proceed with a profitable course of action. Graham began his career on Wall Street as a messenger at the brokerage firm of Neuberger, Henderson or Loeb, posting bond and stock prices on a blackboard for $12 a week. From messenger, he rose to writing research reports and soon was awarded a partnership in the firm. By 1919, he was earning an annual salary of $600,000. He was 25 years old. In 1926, Graham formed an investment partnership with Jerome Newman. It was this partnership that hired Buffett some 30 years later. Graham Newman survived the 1929 crash, the Great Depression, World War II, and the Korean War before it dissolved in 1956. From 1928 through 1956, while at Graham taught night courses in finance at Columbia. Few people know that Graham was financially ruined by the 1929 crash for the second time in his life, the first being when his father died, leaving the family financially unprotected. Graham set about rebuilding his fortune. The haven of academia allowed him the opportunity for reflection and re-evaluation. With the counsel of David Dodd, also a professor at Columbia, Graham produced what became the classic treatise on conservative investing, Security Analysis. Between them, Graham and Dodd had over 15 years of investment experience. It took them 4 years to complete the book. The essence of security analysis is that a well-chosen diversified portfolio of common stocks, based on reasonable prices, can be a sound investment. Step by careful step, Graham helps the investor see the logic of his approach. The first problem that Graham had to contend with was the lack of a universal definition for investment that would distinguish it from speculation. Considering the complexities of the issue, Graham proposed his own definition. An investment operation is one which, upon thorough analysis, promises safety of principal and a satisfactory return. Operations not meeting these requirements are speculative. Though, what did he mean by thorough analysis? Just this: the careful study of available facts with the attempt to draw conclusions therefrom, based on established principles and sound logic. The next part of Graham's definition is critical. A true investment must have 2 qualities: some degree of safety of principal and a satisfactory rate of return. Safety. he cautions, is not absolute, unusual or improbable occurrences can put even a safe bond into default. Rather, investors should look for something that would be considered safe from loss under reasonable conditions. Satisfactory return. The second necessity includes not only income but also price appreciation. Graham notes that satisfactory is a subjective term. Return can be any amount, however low, as long as the investor acts with intelligence and adheres to the full definition of investment. Had it not been for the bond market's poor performance, Graham's definition of investing might have been overlooked. But when, between 1929 and 1932, the Dow Jones bond average declined from 97.70 to 65.78, bonds could no longer be mindlessly labeled pure investments. Like stocks, not only did bonds lose considerable value but many issuers went bankrupt. What was needed, therefore, was a process that could distinguish the investment characteristics of both stocks and bonds from their speculative counterparts. Graham reduced the concept of sound investing to a motto he called the margin of safety. With this motto, he sought to unite all securities, stocks, and bonds in a singular approach to investing. In essence, a margin of safety exists when securities are selling for whatever reason at less than their real value. The notion of buying undervalued securities regardless of market levels was a novel idea in the 1930 and 1940. Graham's goal was to outline such a strategy. In Graham's view, establishing a margin of safety concept for bonds was not too difficult. It wasn't necessary, he said, to accurately determine the company's future income, but only to note the difference between earnings and fixed charges. If that margin was large enough, the investor would be protected from an unexpected decline in the company's income. If, for example, an analyst reviewed the operating history of a company and discovered that, on average, for the past 5 years the company was able to earn annually 5 times its fixed charges, then that company's bonds possessed a margin of safety. The real test was Graham's ability to adapt the concept for common stocks. He reasoned that if the spread between the price of a stock and the intrinsic value of a company was large enough, the margin of safety concept could be used to select stocks. For this strategy to work systematically, Graham admitted investors needed a way to identify undervalued stocks, and that meant they needed a technique for determining a company's intrinsic value. Graham's definition of intrinsic value, as it appeared in security analysis, was that value which is determined by the facts. These facts included a company's assets, its earnings and dividends, and any future definite prospects. Graham acknowledged that the single most important factor in determining a company's value was its future earnings power, a calculation that is bound to be imprecise. Simply stated, a company's intrinsic value could be found by estimating the earnings of the company and multiplying the earnings by an appropriate capitalization factor. The company's stability of earnings, assets, dividend policy, and financial health influence this capitalization factor or multiplier. Graham asked us to accept that intrinsic value is an elusive concept. It is distinct from the market's quotation price. Originally, intrinsic value was thought to be the same as a company's book value, or the sum of its real assets minus obligations. This notion led to the early belief that intrinsic value was definite. However, analysts came to know that the value of a company was not only its net real assets but also the value of the earnings that these assets produced. Graham proposed that it was not essential to determine a company's exact intrinsic value. Instead, investors should accept an approximate measure or range of value. Even an approximate value, compared against the selling price, would be sufficient to gauge margin of safety. There are 2 rules of investing, said Graham. The first rule is don't lose. The second rule is don't forget. Rule number 1. This don't lose philosophy steered Graham toward 2 approaches for selecting common stocks that, when applied, adhered to the margin of safety. The first approach was buying a company for less than 2/3 of its net asset value, and the second was focusing on stocks with low price to earnings (PE) ratios. Buying a stock for a price that is less than 2/3 of its net assets fit neatly into Graham's sense of the present and satisfied his desire for some mathematical expectation. Graham gave no weight to a company's plant, property, and equipment. Furthermore, he deducted all the company's short and long-term liabilities. What remained would be the net current assets. If the stock price was below this per share value, Graham reasoned that a margin of safety existed and a purchase was warranted. Graham considered this to be a foolproof method of investing, but he acknowledged that waiting for a market correction before making an investment might be unreasonable. He set out to design a second approach to buying stocks. He focused on stocks that were down in price and that sold at a low PE ratio. Additionally, the company must have some net asset value. It must owe less than its worth. Over the years, many other investors have searched for similar short cuts for determining intrinsic value. Low PE ratios. Graham's first technique was a general favorite. We have learned, however, that making decisions on PE ratios alone is not enough to ensure profitable returns. Today, most investors rely on John Boor Williams's classic definition of value, described later in this chapter. The value of any investment is the discounted present value of its future cash flow. Both of Graham's approaches, buying a stock for less than 2/3 of net asset value and buying stocks with low PE multiples, had a common characteristic. The stocks that Graham selected based on the basic ideas of investing are to look at stocks as businesses, use market fluctuations to your advantage, and seek a margin of safety. That's what Ben Graham taught us. 100 years from now they will still be the cornerstones of investing. Dashamlav chart. Warren Buffett, 1994. These methods were deeply out of favor with the market. Some macro or micro event caused the market to price these stocks below their value. Graham felt strongly that these stocks, priced unjustifiably low, were attractive purchasers. Graham's conviction rested on certain assumptions. First, he believed that the market frequently mispriced stocks, usually because of the human emotions of fear and greed. At the height of optimism, greed moved stocks beyond their intrinsic value, creating an overpriced market. At other times, fear moved prices below intrinsic value, creating an undervalued market. His second assumption was based on the statistical phenomenon known as reversion to the mean, although he did not use that term. More eloquently, he quoted the poet Horace, "Many shall be restored that now are fallen, and many shall fall that now are in honor." However stated by statistician or poet, Graham believed that an investor could profit from the corrective forces of an inefficient market. Philip Fisher. While Graham was writing security analysis, Philip Fisher was beginning his career as an investment counselor. After graduating from Stanford's Graduate School of Business Administration, Fisher began work as an analyst at the Anglo-London or Paris National Bank in San Francisco. In less than 2 years, he was made head of the bank's statistical department. It was from this perch that he witnessed the 1929 stock market crash. After a brief and unproductive career with a local brokerage house, Fisher decided to start his own investment counseling firm. On March 1, 1931, Fisher & Company began soliciting clients. Starting an investment counseling firm in the early 1930s might have appeared foolhardy, but Fisher figured he had two advantages. First, any investors who had any money left after the crash were probably very unhappy with their existing broker. Second, in the midst of the Great Depression, business people had plenty of time to sit and talk with Fisher. At Stanford, one of Fisher's business classes had required him to accompany his professor on periodic visits to companies in the San Francisco area. The professor would get the business managers to talk about their operations, and often helped them solve an immediate problem. Driving back to Stanford, Fisher and his professor would recap what they observed about the companies and managers they visited. That hour, each week, Fisher said, was the most useful training I ever received. 5. From these experiences, Fisher came to believe that people could make superior profits by 1. Investing in companies with above average potential, and 2. Aligning themselves with the most capable management. To isolate these exceptional companies, Fisher developed a point system that qualified a company by the characteristics of its business and its management. As to the first, companies with above average potential, the characteristic that most impressed Fisher was a company's ability to grow sales over the years at rates greater than the industry average. 6. That growth, in turn, usually was a combination of 2 factors: a significant commitment to research and development, and an effective sales organization. A company could develop outstanding products and services, but unless they were expertly merchandised, the research and development effort would never translate into revenues. In Fisher's view, however, market potential alone is only half the story. The other half is consistent profits. All the sales growth in the world won't produce the right type of investment vehicle if, over the years, profits do not grow correspondingly, he said. 7. Accordingly, Fisher examined a company's profit margins, its dedication to maintaining and improving those margins, and, finally, its cost analysis and accounting controls. No company, said Fisher, will be able to sustain its profitability unless it is able to break down the costs of doing business while simultaneously understanding the cost of each step in the manufacturing process. To do so, he explained, a company must instill adequate accounting controls and cost analysis. This cost information, Fisher noted, enables a company to direct its resources to those products or services with